Okay, guys, we're at the top of the hour. Let's go and kick off. I'd like to do a short introduction to 10 Capital, introduce our investors, and then we'll kick off with our first pitch. Let me share my screen here first and wanted to tell you more about 10 Capital so people know a little bit about what we're doing. Many of you have already heard this. Many of you could give this presentation for me if you wanted to, I'm sure. But with that, let me kick into our slides here. Um, Here at 10 Capital, we're based in Austin, Texas. We've been doing this work since 2009. We were originally called Texas Entrepreneurs Network. Over the years, we've grown our program to be nationwide, and we've now moved into the Middle East, North Africa, and have already seen some work in Europe as well. At heart, what we do is we help startups and growth companies and investors connect for funding through our program. And we have services around fundraise preparation. We coach on campaign strategy, as well as the investor engagement. We make introductions through email, through online events, and in-person events. So we've been helping companies raise funding since 2009, have raised over $1 billion, and have over 850 companies through the program. In short, we provide the legwork, saving you time and money. We also help build startup funding ecosystem by helping build capital for it. And we help high net worth start family offices as they invest in emerging managers. We help VC funds find limited partners, mostly through our family office program. These family office programs are in Austin, Dallas, New Mexico, Southern California, and the Bay Area. We also help angel groups find members. That's how they fund their program, is finding more people. And we've helped over 35 angel groups since we started build and grow their program. You can see a list at the bottom. We do have a new Substack out talking about the use of AI in diligence for the investor. It also applies to startups. If you take a picture of that QR code, you can subscribe to what's called the 10 Capital Connect. Every week, you'll get a new prompt to try out and an article about how to diligence a startup using AI tools. We're coming out with agents soon, so look forward to that, and we'll share more information here in a moment. So with that, let's go ahead and meet our panelists. We have with us today several companies and four companies that are pitching. Each will have 10 minutes to pitch, 10-minute Q&A. And so if I go to the panelists, let's start with Jeremy Song. Can you tell us about yourself and your fund, Jeremy? Jeremy is there. If not, Chris Reynolds, can you tell us about yourself and your fund?
Oh, sorry. I'll go after Chris.
Go ahead, Jeremy.
Okay. Sorry, I was just coming off mute. Good to meet everyone. Very briefly, 30 years in healthcare and life sciences as an investor and entrepreneur. My fund, B74 Bio, is specifically focused on lending to clinical stage, to be clear, clinical stage, phase one, phase two, or phase three ready companies that have either an explicit or expressed interest in running their trials in tax advantageous regions like Australia. And so we'll lend up to 35% of the capital required. So good to meet everyone.
Great. Thanks for joining us. Arash Razay, if you could tell us about yourself, that'd be great. Don't know if he's available yet or not. Let's see. We have with us Tabriz Ibrahim. Tabriz, can you tell us about yourself? Still coming in. And let's see. Don't know if Chris is back yet or not. All right. We will come back to these guys here in a little bit. With that, let's go ahead and kick. With that, we'll go ahead and kick off with Randy Hubble's first presentation. Randy, go ahead and kick off and give us your presentation. At the end, we'll have some questions from the investors. We'll have 10 minutes for the pitch and then 10 minutes for the Q&A.
Okay, great. Thank you, Hall. Hello, everyone. I'm Randy Hubble. I'm the CEO for Solaris Endovascular. We're a medical device company with a platform technology. Our first two products are what we're going to focus on today. One is actually commercially available outside the United States. The second one builds on that. It's a combination product that is breakthrough designation granted by the FDA just last month. Here's the kind of the summary, the synopsis. I've tried to de-risk this as much as possible for the investors. We do have recurring revenue with our Solaris SX self-expanding stent outside the United States. We've completed a phase 2 data on the next generation Solaris drug-eluting. It's a combination product. The data are fantastic. I'm going to share that with you. This is set up for an exit, so we have a very strong strategic interest and support in multiple signed NDAs. Management team's done this before, but very capital efficient by the way we've set this up. And this is designed as a bridge round that we're going to be closing here shortly to reward the early investors with a higher return. So what do we do? So patients with peripheral artery disease have atherosclerotic disease, same disease that's in the coronary arteries throughout the body, in the arms and legs and in vessels of the arms and legs. And it creates a blockage. It prevents blood flow. It slows it down. And that's a challenge. Dialysis patients, very similar thing, arteries and veins that get occluded have a lesion, a stenosis, a neointimal hyperplasia, scar tissue. It's all the same thing. It prevents the flow of blood, and that's bad. So dialysis patients have an artery and vein tied together, take bloods out, put the blood through the dialysis machine, put it back in, and that is a life-saving technique. And it only can be done if they have good access. So we treat the access once it fails. Our first product is Solaris SX. You see a picture of it. It's a self-expanding stent. It's nitinol stent covered with electrospun PTFE, the latest version of PTFE. Only one of two companies in the world with electrospun. It's approved in 45 countries, including MDR in Europe. The second program is Solaris DE, which is it's a combination product. It builds off the platform of the SX and just puts drug on the very edges of that stent, and it elutes over 60 days. We have fantastic data, and the reason we have that product is because of edge restenosis. And I'm going to explain edge restenosis very quickly and very easily. But the program one, the Solaris SX, it competes against Gore, Bard/BD, and Merit, three formidable companies that have a competitive product. Where we choose to compete, where we put some resources and you have a good independent distributor, we're number one, and that includes Turkey and Brazil. And it's done because we have electrospun PTFE, which is stronger and thinner, but also our great flexibility and strength. Our product, the Solaris SX, already has clinical data. Patency is a way to measure if a vessel is still open. And our patency rates out to 12 months after replacing a Solaris SX to open a vessel is over 95%, 94%. So it's a very, very well studied. In dialysis access patients, these patients are terrible interventions. They have 3 to 6 interventions a year to maintain their access. The primary endpoint is 6 months. At 6 months, they look for target lesion primary patency, which means after the lesion is repaired, how durable is that fix? The standard of care, and this is changing, but it's still considered standard of care, is balloon angioplasty. At 6 months, only half of those lesions are still viable and need to have another intervention. With the Solaris XS, we have XX, we have 75% patency. Big step up over balloon angioplasty, a good treatment effect, but still a problem. And the problem is edge restenosis. What you see here is a stent. This is not even our covered stent. This is a competitive stent. That's the nitinol, the mesh there. And then the black tube in the middle is contrast, showing the vessel is open. Our stent and the 3 other stents all suffer from the same thing, which is edge restenosis. We almost never get a stenosis in the body of the stent because the PTFE does a wonderful job of blocking the cell proliferation. But the cells migrate on the edges, and you can see the white, milky narrowing there, and that's an edge restenosis. Unfortunately, in dialysis patients at 6 months, 25% of them are going to have a restenosis, a narrowing, and needs to be fixed again, very costly, and it's life-threatening to the patient. We have fixed this. We have put a drug on it. You can see the blue dots on the stent on the left there. That elutes over 30 days, but it creates durability for months and years to come after that. The action is all in the first month or so that you are preventing the edge restenosis. And this is a proprietary technology. We're the only ones in the world with a drug-eluting covered stent. The drug is sirolimus. The sirolimus is been studied for 25 years. It was the first drug to be used in any drug-eluting stent in the coronary. We have adopted it because I was the launch leader at J&J for Sacher, the first ever drug-eluting stent. We have phase 2 data, 115 patients. The primary endpoint, this is dialysis access patients, is 6 months target lesion primary patency. As I've just reviewed, the balloon angioplasty is only about half of those patients are durable before they fail. With our covered stents and the other three, the combined data between all three of them, you have a patency rate of anywhere from 70 to 75%. Our drug-eluting stent has 95% patency, and that is just wonderful. This is the half of the patients at the 6-month endpoint. This is actually 40 patients on treatment. That means 40 patients that receive the drug-eluting stent. Those patients are the last of those patients are coming up on their 6-month endpoint now, and so we'll have the full data set this summer, and we expect that 6-month data will be sustainable and it will stay the same. The picture on the right shows no neo-intimal hyperplasia, shows no narrowing. We are seeing this out to 12 months as well. We have the same pictures at 12 months. And oh, by the way, our target lesion primary patency, our patency rate out to 12 months is looking very, very spectacular. We're going to shift this industry from talking about a 6-month endpoint to a 12-month endpoint because of our data. This is a large market. This is not only for dialysis patients, but for iliacs and renals and femorals. 1.5 billion today, growing to 3 billion with the drug-eluting. This has been set up for an exit. That's all I do now is exits. I focus on the exit and I work backwards. These are the things that I took away from my 13 years at J&J, 5 at Boston Scientific, and 8 years at IBM on the buy side of technologies. What they really want is a tuck-in. They want to acquire technology and push it through their current infrastructure, and they want revenue at time equals zero. Time equals zero being when the FDA approves it. I focus on the FDA because it's always the largest market in the world. So, you need to have an issued patent at that time. You need to have the FDA approval with a highly differentiated technology that meets an unmet need, compelling clinical data, clear path to reimbursement, a fully engaged and strong KOL support, and scalable manufacturing so they can launch it and get that revenue. We're on pace to have all 6 of these when we get regulatory approval in 2030. This is set up for one of these large multinationals to acquire us. They're already spending millions of dollars on Salesforce calling on interventional radiologists and vascular surgeons, the doctors that put these products in. We're in discussions with many of them already. We are also the ones that are not listed up there are Gore, Bard, and Merit. We're in conversations with them as well because we'll destroy their market share because the drug-eluting is the next best thing. I opened this financing up with a bridge round because I've got so many meaningful milestones that we have been hitting. And so we opened this up at the end of last year. We've hit the milestones we said we were going to hit. We're doing what we said we were going to do. We used the funds. We've hired 3 FTEs, and that's done. It should say done. We've got a 4th that we're looking at now. We did get breakthrough designation. Our IDE is what you use to get the FDA to say you can start enrolling in your phase 3 study. We've submitted part 1 and gotten feedback from the FDA already. So we've got a $5 million bridge round. We'll go to a $25 million Series A. This is a very straightforward play. 1 pivotal study, 1 PMA approval. PMA is the regulatory approval from the FDA, and then acquisition. And that will happen in 2030. The window actually will open in 2029. We'll be acquired for $500 to $600 million. Our valuation cap is $50 million, and we're projected to have 10 to 12x return. Our revenue forecast supports a discounted cash flow analysis of $550 $600 million acquisition. And I've done this before. Carmel was acquired for $500 million. Cardiva was acquired for $500 million by Haemonetics. Carmel, I took over a 7-year journey to get public on the NASDAQ for $150 million. And here's the terms. Our round closes on June 30th. We've had substantial due diligence done by multiple family offices, angel groups, and also venture capital groups. 3.7 of the 5 is already done. Another million's committed. We got 2 to 3 million soft circle that we're working to close by the 30th. Thank you.
Great job, Randy. Thanks so much for that. Let's go to the audience. Our first question, Jeremy San, what would be your first question?
No real first questions, Randy. It sounds like you've done a great job, and you're on track to meet your objectives. This is unfortunately it's a little bit outside of the scope of my investment remit, but kudos to you.
Yeah, thank you.
Great. Let's go to Jasper Cannon. Jasper, did you have a first question here?
No, sorry. I joined like 3 minutes ago.
Okay, we'll
I
catch
have
you
to
up on the
review
next
everything.
one. Yeah, great. And with that, let's go to Pete Ippolito. Pete, what questions do you have, if any?
Yeah. Oh, hey, Randy. Well, great presentation. Really enjoyed it. I guess maybe I missed it, but question I have is what milestones do you need to reach, specific milestones and accomplishments that you need to reach prior to your liquidity event?
Yeah, good question, Pete. So, look, I think the med tech ecosystem is set up for large multinationals to acquire technology and to bring it into their organization. There's different ways that happens. If you're a 510(k), which doesn't typically have a lot of clinical data, you're likely going to have to demonstrate validated revenue. If you're a PMA, which is only 5% of the approvals, and it's $100 million in 10 years, and we're two-thirds, three-quarters of the way through it, then you're likely to get approval at the time of FDA approval. You're likely to get acquired. The window for us opens a little bit sooner than that because this phase 2 data we have is so strong, and we're going to continue to track these patients. So I think the trigger for us is going to be in 2028, we'll have 12-month data for 120 patients on treatment for the drug-eluting in the phase 2, and we'll be enrolling in the phase 3. The next substantial milestone will be the data readout, top-line results of our phase 3 study in 2029. So, Pete, it's really clinical driven because the clinical success will determine a high probability of regulatory success.
Okie doke, great answer. And I'm not really familiar with the medical field, but I've heard the term efficacy. So, what is the metric of efficacy that you're trying to achieve? In essence, what will your positive clinical trials results indicate?
Yeah, so the phase 3 will be just like the phase 2. We'll start with dialysis patients. At 6 months, we'll measure target lesion primary patency. So what that means is when a stenosis or lesion occurs, it is then fixed and repaired. And then at 6 months, they'll look and see if that vessel is still open, if that repair is still sustained and durable. And so our target lesion primary patency at 6 months is the primary endpoint for our phase 2 and our phase 3. And we have a 95% patency, meaning 95% of those patients still had a durable fix after we repaired it.
Okay, great answer. Thank you.
Great. So, Randy, can you tell us more about the time frame for your fundraise? When is it closing up?
So this bridge round is closing on June 30th. We've already had substantial due diligence. Multiple folks are now sharing due diligence reports. And so we're just trying to land the plane here and get this done in the next 2 weeks. We already started the pre-prep, so to speak, for our equity round. We need about 25 million to 30 million. That gets us to exit. It actually gives us 30 million, gives us a full year of contingency. And we have VCs that are currently in due diligence for that round, as well as we're going to hire TD Cowen as our banker to help create an auction for the strategics to participate in the round as an equity investor and maybe a build to buy structured deal.
Assuming that goes according to plan, what's your plan to exit for the entire deal? What target date do you have in mind?
I think 2029. I think second half of 2029. So a little over 3 years, 3 to 3.5 years, as the data continue to roll in. I think somebody will pull the trigger. It could come earlier. We could get as we go through this process where we're looking at bringing a strategic on the cap table, they may decide to acquire us now. That trend started to happen in medical devices as of 2026.
And how much revenue do you have currently going through the company?
So we have $5 million of annual recurring revenue through Solaris SX. We're not bringing that product to the US. That's an OUS product. The second product, the combination product with the drug on it, is superior. And so we'll continue to sell it overseas through our partner. And we actually we'll receive royalties on that $5 million of 7 to 8%.
Great. Jasper, did you have a question?
Yeah, so somebody shared their otter, and so I've been looking through the transcript. Now you said two products, and I want to make sure I understand. When your equity, sorry, your dollar amount asked, are you is that everything, or is that one specific product?
The dollar amount, talking about sales or fundraising?
The fundraising amount. Am I investing in one thing, or am I investing in the whole company?
You're investing in the company. The company has the unencumbered rights to the platform, which has these two products in advanced stage and others that are in conceptual stage. So whoever acquires us will acquire the company and get all the assets.
Okay.
Any other questions?
No, thank you.
Okay, great. We're at the end of our time, Randy. Thanks so much for a great presentation. With that, let's go to our next presenter. Keegan, can you launch your slides and kick off when ready? This is called Chillshark.
All right. Can you guys see my screen?
Yes, we can.
All right. So my name is Keegan O'Connor. I'm the co-founder and CEO of Chillshark. I wanted to start kind of with a few questions, and I'll just answer them myself in this format. But when you look at the amount of money that's spent on ICE and the value that this can be, the value that adding wellness amenities can add to a real estate or hospitality project, it's pretty remarkable. So when you look at the Texans, how much do they spend on ICE? They spend about $120,000. When you look at the real estate, if a developer adds in wellness amenities like cold plunges, sauna, the percent lift on the actual property value can be anywhere from 10 to 25%. And then for an ice bath, for a luxury Kohler ice bath, the retail price point is around $20,500. And then from a hospitality perspective, Four Seasons. So Four Seasons is going to be deploying Chillshark as a service in their properties. What are their internal projections? Well, they believe that they'll be able to utilize Chillshark to generate $100,000 in cash flow. So what this really shows you is the product set as it stands is really inefficient. The price point is extremely high, but the value is there where hotels and real estate developers are looking to add these amenities. And our solution to this problem is creating a better product. And ultimately, our product is less expensive, it's portable, and it solves the problem for them in a way that they can actually utilize. So this is exactly why we have the demand that we do. And our core beachhead market is luxury hospitality. So we have a 2-year contract signed with Four Seasons. We have 4 Marriott pilot locations selected with the vision of ultimately, they said there's about 600 to 750 properties where they could see them getting a lot of utilization out of our product. Then, we've been paid by the Nuggets, Grizzlies, and then we've pre-sold close to 127 units. So Over the course of the presentation, I'll talk a little bit about the problem, our business model, and then ultimately, how does the investor generate a return? But we're seeking $1.5 million at a $10 million pre-money valuation. So the problem within hospitality is very obvious. So this is a over dramatized example, but basically right now the solution within luxury hospitality is wheeling ice up to individual guest room. And it's the same story when they have athletes traveling on the road. So being able to turn this headache into a cash generating asset is something that's super attractive for operators across the board. And when you look at the problem itself, the guest, there's obviously demand for this because wellness is replacing a lot of the spend that alcohol traditionally did, but the infrastructure itself doesn't support, buying large tubs and outfitting them because it's either going to be super expensive from a CapEx perspective, and that's where the legacy products really fail. But then when you look on the consumer tubs, they aren't really an option either because they don't fit the brand standard. And then, the actual companies that offer this, they don't trust as well. And when you look at this as a whole, though, we're not creating a new market opportunity, or we're not creating demand. It's already there. The athletic trainers in Four Seasons Philly alone, there's 73 teams that stay there a year, and they have to get ice for every single one of them. So we're giving them a better solution, which is Chillshark. It fits into the brand standard. It gives the premium user experience. And then, on top of this, they have the fleet management, which allows them to deploy this at scale. And the way that it works, very simple. They just fill up the tub, they roll this up into the room, pre-schedule it, and then it's ready for the athletic trainer or the guest. So when you think about why hotels are so excited about this product, is ultimately it creates revenue, which is the biggest driver, but it also reduces the CapEx spends that they would have had on a larger tub. And then from an operational standpoint, what you don't realize when you think about deploying a cold plunge within your hotel is you have, for example, you have somebody who can fix your pool, you have somebody who can fix your hot tub, but you're solely reliant on the vendor who you partner with for cold water immersion to come and fix your cold plunge. And since we have a different product, we have a different service model where we can remotely log in to, we're able to see what the problem is and remotely diagnose it, or we can just ship them a new unit because you need to have zero downtime in these luxury environments. And then obviously from a brand perspective, like the design really matters. So having something that actually fits into their brand standard. Now, when you look at the traction, it speaks for itself. We launched one of the largest Kickstarter campaigns in category history. We have, paid customers for across the NBA and NHL, but within luxury hospitality, we realize that if we focus on this, it unlocks the rest. And so what I mean by this is by getting into luxury hospitality, we have a demo showroom in every major market. And we're already being pulled into the luxury residential projects. So, the 150 unit property in Miami, there's a 750 property in Dubai that we're being pitched into, and then an 18 unit property in, Nashville. And so the hospitality has started to introduce us to the residences, and having a demo showroom in every major market. This also means that whenever the pro athletes or athletic trainers are traveling, they're adding this onto their master contracts. So we're getting visibility and access to all the pro athletes and teams. And what this all does is it sets us up to access the premium consumer, not through spending money on ads, but through our distribution channels. So Marriott and Four Seasons are both planning on reselling our product. So hospitality is the beachhead that unlocks the rest. And when you look at our business model, there's very simply how we make money. We have the hardware sales. The hotels can use it to generate cash flow. They can put it in the room to increase the nightly fee. The residences can add this in to increase their property value. And then there's a variety of other channels that can utilize this as well. From a recurring revenue standpoint, we have the revenue share. We've already had that signed with Four Seasons, so we get 25% of any cash flow generated from them using the Chillshark. So then we have some potential leasing options that we're exploring. Then you have fleet management and app subscription, and then replacement and service kits. And when you look at the unit economics, very attractive at scale. We have a 6,500 retail price point, but over a 5-year period, we're looking at about 42.5% gross margin. So even on the conservatives case, this still scales. When you look at the actual upside of the business and the market, it is what we have is a high price point, high velocity sale that's high margin. So we don't need to sell 1 million of these to hit our numbers. Starting out, really owning luxury hospitality, expanding to residences, and then ultimately scaling up to the consumer. We only need to get up to 20,000 units a year to really hit our numbers. And so when you look at the TAM, obviously, you have a $22 billion TAM across thermal recovery and, recovery coaching. But if you look at this from a bottoms up perspective, a more realistic assessment, 60,000 luxury properties, conservative adoption rate, plus the flywheel into consumer and athletics, very easily, can make a case for that $100 million plus, opportunity. When you look at the gap in the market, Chillshark is the first company to approach cold water immersion in a way that actually makes sense for the customer. You look at Plunge, yes, they went from 0 to $100 million in sales in 3 years, but they just sold people a bathtub. They're unable to access this market with their product set. So we're going to be able to capture that pent-up demand. And when you look at the moat itself, yes, we have IP, we have the trademark, but ultimately the design plus distribution plus data plus service being integrated into this business model is what gives us that moat. And we believe that is what's going to make the difference over time. One of the most important parts of this entire business is the team, and it's not me. The biggest, obviously I have backgrounds with entrepreneurship and sales, but the key signal here for investors is Venkat Mallela joined, and he left one of the world's largest hot tub, cold plunge, and sauna companies in the world. And he left to pursue this opportunity because he understands the market, and there's no one more qualified in the world to execute on scaling this from a hardware perspective, but also assessing the market opportunity. So on top of that, when you're looking at deploying into hospitality, we really needed mindshare that understood the market. So we have Glenn Sutton, who's a very experienced operator. He runs the Fulham Pier Properties. And then Tatiana, obviously, she's been in the luxury world. She's worked with a ton of different luxury brands, so she really gives us access. Rakesh is one of the leading wellness advocates within Marriott Corporate, so he's really spearheading the launch with Ritz-Carlton. And then Inga has a ton of connections within luxury residences, so we are really well positioned to become integrated into hospitality. So right now we're raising capital scale up manufacturing, 1.5 million. And ultimately this is really going to, get us to that Series A raise in, 16 to 18 months. So with that being said, when you're thinking about the exit, we've already been approached by a lot of strategics. So we've spoken with Kohler, Masco, Roca Group, Therabody, but ultimately our product is a natural, tuck in for one of these larger organizations. And Venkat has background, he worked for one of the corporate venture funds at these companies, so he knows how these deals are priced. And so, we see, if we execute on our strategy, we really do have the opportunity from that, 500 million plus in 5 years. So, with that being said, happy to take any additional questions.
Great presentation, Keegan. Let's go to Pete Ippolito. Pete, what are your questions?
Actually, I do not have any here. This isn't my playing field, so I'm going to skip asking a question. Thank you all.
Sure. Jasper, what are your questions?
I don't have any at this time. Thank you.
Okay, great. And Jeremy, you had a question there before, but did you have any others?
Yes, it's not my investment area, but maybe just some suggestions. So I'll tell you, you converted me over your presentation. So if I were investing in this space, it sounds much more interesting than the start. But maybe just a couple of kind recommendations.
Okay.
For me, and this is just my opinion, like for me, what resonated was two things. One was the fact that there was a huge ramp and exit already in the market. And so
Got it.
I'd almost start with that, right? So as an investor, I'm looking like, how risky is this? And is there an exit opportunity? And it's demonstrated. And then you're telling me why you're better. The second piece was your video. The other stuff that you were asking in your first two slides
Doesn't
didn't
matter.
really, yeah. I mean, you're going to come back to that, what the opportunity is. And then I did feel like your sort of like market sizing was a little weak. Like I don't really know how you get to this 500 million and then I'd way simplify your go-to-market strategy. You've got way too many service products and offerings and all that other stuff. It may be that those are all true, but I just want to hang my hat on like one number, maybe two, but like what's going to drive 80% or 90% of your top line revenue. So that's what I want to know. How are you going to sell? Because it's very hard to be in market, but multiple different, revenue streams. Oh, I'm going to go distribution here. I'm going to go direct here. And investors generally don't want to hear that.
Got it.
Cool. Thank you for that, Jeremy. DeBreeze, what are your questions?
Thanks. Great presentation. I just had one on the, I think it was a revenue mix slide where you had different ones shown, and I was wondering what's sort of the breakdown for that, and do you see more growth in one versus the others?
For revenue mix here?
Yes.
Venkat, you want to take that one?
Yeah. So most of the revenue is coming from the hardware sales. But again, I came from this industry, so you have an aftermarket service platform revenue, and that's usually around 25% of the hardware. So it's an add-on because you have to service these units in the field. So we are capping that at around 25% of the hardware revenue by year 5. I think that's a little conservative, and that includes the fleet management software, the service kits, and other services, support services which we provide. And this is exactly how we used to, or we still do it. I used to work at Watkins Wellness, part of Masco, and that's basically what we did in terms of revenue mix. But essentially, there's just two components to the revenue: hardware, which is 75 to 80% of the revenue, and the rest of it is consumables because we have filters, sanitation devices, the UV bulbs, we have the software support. All that is just part of the whole platform, which provides additional revenue. I hope I answered your question. So.
Yes, thank you.
So, Keegan, what's your exit strategy here at this point? Where do you think the likely exit is going to come from?
So we're in like stage 4 of 6 in diligence with Roca Group International. So they're a $2 billion tub manufacturer. They're looking at a strategic investment, but we would likely anticipate our first offer from Roca or Kohler or Watkins Wellness being within market 12 to 18 months. So we're very likely, the exit's very likely going to come from a strategic. And Venkat, you can touch on this too if you want.
Yeah, I mean that's how I had met Keegan, because I exited Watkins Wellness as the vice president of engineering and manufacturing tech, and I was there for 10 plus years. Watkins, again, is a part of Masco Corporation, and one of our sister companies at Watkins was Delta Faucets, again, big tub manufacturer. They're a competitor to Kohler. So I was evaluating Chillshark for a strategic investment through that. And I've been part of many acquisitions of this manner. So typically there's many terms for this. They're tuck-ins or bolt-ons. So either you acquire a company for the distribution channel or the product which fits into a current distribution. So there's many reasons for that. So some of these multiples which we have put in there are from my experience, what I've seen, I've been part of 3 acquisitions in my time at Watkins. So.
Great. Thank you for that, Venkat. With that, we're at the end of our time. Thanks so much, Keegan, for a great presentation, and Venkat for great responses as well. With that, let's go to our next presenter, Angiex. Paul, if you could launch your slides and kick off when ready.
All right, thank you, Hal. Here, just a second. Let me get back.
We see your slides.
Okay, terrific. So Angiex, a very exciting company with a very exciting drug. It's the fruit of 24 years of biology research and over 10 years of company building. So our drug, AGX-101, is an antibody drug conjugate. This is what it looks like. The antibody searches out a protein called TM4SF1, wherever it is in the body. And in adults, where it is on the vessels or the cancer cells of solid tumors. And so we're able to attack 2 parts of every tumor, the vessels and the tumor cells. And by attacking those 2 parts of the tumor, we're able to eliminate all the known causes of cancer mortality. So by eliminating the blood vessels, we prevent tumors from growing. And by killing invasive and metastatic tumor cells, we prevent the cancer from disrupting the body. And so the next 2 slides just illustrate these 2 mechanisms. So this is images from a mouse study done about 12 years ago at Harvard, where our founders came from. And so this just illustrates when we treat the mouse in general is not affected. They eat, sleep, live normally, but we eliminate all of the blood vessels within the tumor and the large vessels that feed and drain the tumor. So there's no longer a blood supply to the tumor, and that causes a mass necrosis in the tumor, which ends up healing by scarring. In addition, our target, TM4SF1, is required for invasion and metastasis, and so it's among the most highly expressed tumor cell antigens known, and it's highly expressed across all solid cancers. So any cancer that can kill you, that patient, by the time it's a late stage disease, most of their tumor cells will be high expressors and sensitive to our drug. So then just a few slides to show what our drug does in the body. So this is what it does when it's given at about half the optimal dose. And so this is a dose where we kill the tumor blood vessels, but the dose isn't high enough to reach the tumor cells. And so the tumor cells survive. But you can see what happens. This top row was at baseline. This was the original tumor. And the whole tumor goes dark on this PET image. That's because there's no longer any live cells here to take up glucose. And these are normal organs. This is the liver, this is the spleen. And so you can see it's very dark compared to the normal organs where the tumor used to be very bright. But since we didn't kill the invasive tumor cells, surviving tumor cells were able to go out and invade adjacent normal, and so you have this surviving tumor shell. But what we need to do is go to higher doses, such as this dose, and then we still get this mass necrosis of the original lesion, but there's no growth because what we believe is there's no surviving tumor cells. And so we're over the next few months, coming months, we're going to be returning to these doses with this PET imaging. And so we should be able to prove that we're killing all the tumor cells. And we've already taken 1 pass through the key doses, and we've established safety. So we figured out, we believe, how to avoid any severe adverse events. And so as long as we dose on this blue line or to the left of it, we've never seen a severe adverse event. And we can get And we appear at dose levels of 6 or higher to have universal efficacy where we kill probably around 90% of all the tumor cells with each dose. And so very promising. And we're starting to see evidence of a survival benefit. So this is just illustrating uh, one patient with metastatic pancreatic cancer. He was dosed at too low a dose, but sometimes even at the low doses, the tumors are favorably located, and we can kill a lot of the tumor cells. So anyway, this patient was on through 9 cycles of treatment. Uh, Tumor never grew, and there were no adverse effects through the first 7 cycles, then only grade 1. And the patient is still alive today, 20 months after starting treatment. And when we get to the better doses, nearly everyone appears to be surviving. We have 6 evaluable patients dosed above 6 mg/kg, and 5 of them are still alive, with a median survival of about 9 months. And and just for comparison, the average life expectancy of these phase 1 patients is 4 to 5 months, and we had median survival of 4 months at the lower doses. So anyway, very promising therapy, and this is our path to approval. And so we're optimizing dosing this year, demonstrating efficacy and safety. Then we'll gather further data in expansions while we talk to the FDA and plan our registrational trial. Start the registrational trial mid-2027, which should have enough data to apply for approval in late 2028 and receive it in 2029. We're planning an IPO next year upon good clinical data. We've got a world-class team, the best in the business in ADCs, and our scientific founders made the top 2 discoveries in the field of angiogenesis. Great opportunity. We're very excited. We're just on the verge of the major value inflection where we, prove that we're largely eliminating tumor cells from every tumor of every solid cancer. And you have the opportunity to come in at a valuation below $100 million. We have 2 ways to come in. There's a convertible note with a $100 million cap, 20% discount. Or we have an equivalent to equity via a special purpose vehicle, which has previously invested $10 million into the company. And the stock is qualified small business stock, so there's potential for tax-free capital gains. So in conclusion, I just like to say there's a lot of people that need our drug, and we need investors. So, it's a great opportunity to team up and make some money through your investment and help us save lives. So I hope you'll join us.
Great presentation, Paul. Thanks for that. Let's go to Jeremy for our first question. What question do you have, Jeremy?
Sure. Paul, thank you. And yeah, thoughtful presentation. A number of questions. So just first and foremost, and it's possible that I missed it. Where are you in terms of sort of getting to clinic? So what's your timing in terms of first in human?
Yeah, well, first in human was July 2024. So this was all clinical data. So what's happened is we took a first pass through our dose escalation. And we found that
No, I saw that. I didn't realize this was in human. Okay,
yeah.
got it. And so then what's the next clinical stage for you guys?
Yeah, so what we're doing is further dose optimization. So we had 2 problems with our initial dose escalation. One is we were scaling by actual body weight, and that led to overdosing the obese.
Okay.
And we found a better scaling would be ideal body weight, and that moves the obese out to the right here and separates them from the patients who didn't have these adverse events. And it also helps to stratify by blood pressure. Um, we think we figured out how to get to, consistently high doses without severe adverse events. So we'll be proving that safety in the second pass. And then the other thing we've done is we found that So this is what we saw in CT scans. So, we have no off-tumor activity on CT scans. We have strong on-tumor activity that, the tumors change. They become fibrotic, necrotic. They can develop cavities or scars from the necrosis. But we just didn't know how many tumor cells had survived. And so we introduced this FDG PET imaging. So on the second pass through, we'll have the FDG PET imaging. We'll also have circulating tumor DNA assessments of tumor burden. So we'll get a much better idea of the level of our efficacy. And that's really what a lot of the larger investors are waiting for is they want, demonstration that the tumor burden is substantially decreasing. And
Have you looked at, just in the spirit of time, have you looked at running, would you be willing, or have you looked at running your trials in regions other than the US, like specifically Australia?
yeah, we looked at Australia originally and came close to going there, but we were concerned that it might be a little slow.
Mhm.
And it was an issue for us that the tax refunds would come 18 months late. So if we'd known about you, maybe
Okay.
we would have gone into Australia then. But we're in the U.S. right now, and
Okay. If you are willing to reconsider your decision around the US, and you don't have to do the 100% of your trial in Australia.
right.
You just have to center it in Australia.
Yeah, no, we can consider that. So yeah, we should
If
get in touch.
that's consideration, then just reach out. Um,
Okay,
we can
thank you. Yep.
chat
Yeah,
more.
I'll make an introduction. Yes. With that, let's go to Jasper. What are your questions, Jasper? Jasper's still there. To Breeze, did you have any questions?
I don't.
Okay. And Pete, how about you? Pete Ippolito, what do you think?
I do have one question, and thank you, Paul. I hope your product is very successful. So my one question is, can you provide a few details regarding your intellectual property protection strategy? If
Yeah,
that applies.
we have a very strong position. So we've benefited by being the only people working in the field of TM4SF1 therapeutics. So minimal work. There's only 175 papers in PubMed on the target, and no other drug developers. So, there's very little prior art, and also it's a very unusual biology. So our drug internalizes to the nucleus, which is a different destination than other ADCs. And it's a vascular antigen, so a different site of tox, and that leads to different design elements. So we were able to increase therapeutic index tenfold over a drug made by Pfizer against this target that was based on the best existing ADC technologies, and that was due to 6 very significant changes, which were the basis of a broad patent set of claims that should protect us against competition for quite a while. So basically, we have freedom to operate. We have 12 patent families. We think we're strongly protected against all competing TM4SF1 directed conjugates for about the next 15 years. And we'll be filing clinical patents pretty soon, which should give us another 20 years of protection against biosimilars and a number of the best clinical methods of use. Plus there's additional exclusionary periods for rare cancers and other opportunities. So, we've got, probably the most favorable patent situation of just about any biotech I'm aware of.
Okay, very good. Thank you.
Great. Uh, and Paul, what's your thought about the Middle East at this point?
Yeah, so as you know, we're very interested. We've been making connections. We have a commitment for a $5 million investment from a Middle Eastern investor. We're talking seriously with a hospital in Abu Dhabi, and we're looking to build our relationships in the Middle East. And the middle several of the GCC countries with their Vision 2030 are very interested in building up healthcare and potentially becoming sites for medical tourism or other kinds of economic development approaches. So it could be an opportunity to get to approval early and build something, build business there. So.
Great. All right. Well, thank you so much for that. Great presentation. We're at our time. With that, let's go to our fourth presenter. We have with us today Spencer Madsen of AccuBreath. Spencer, if you can launch your slides and kick off when ready.
Good afternoon, everybody. All right, we're up and running. Correct?
Good to go.
See that?
Yes, we can.
Great.
Go ahead.
Great. My name's Spencer Madsen. I'm CEO and co-founder of AccuBreath. We're a medical device company that is aimed at revolutionizing emergency ventilation. And the situation that we want to improve is that when a first responder arrives on scene, they reach into their bag, they grab out a life-saving technology. Got one in my hand. It's a bag valve mask that was invented 70 years ago. Doesn't meet today's standard for heart or lung care, and it doesn't need to because it's grandfathered into the FDA because it's older than the FDA. The device itself has no feedback, no safety mechanisms. The reason why it's used is because it's cheap and disposable. This whole thing is used one time per patient and thrown away. But at $20, $25 per unit, it is what is typically used out there. It is designed in such a way to only make sure that you do it effectively, you have to use two people. One to hold the mask down on the patient's face as tightly as possible, and the other first responder squeezing the bag, making sure they don't squeeze it too fast or too slow or too hard or too soft. Because with one, they underventilate the patient and they can die, or two, they overventilate the patient and they can cause lung injury. And these situations have clinically been proven to be difficult, inconsistent, and unfortunately, people do get injured. In the US alone, it's just under 200,000 patients receive acute lung injury due to poor ventilation. And there's actually documented cases of 70,000 patients in the US that die of acute lung injury because oftentimes it goes unnoticed while they are dealing with other issues in the hospital, and then it becomes a major health concern as they're recovering. The competition out there, and the reason why no one else has been able to do this is essentially due to a few aspects. First, the bag valve masks, they don't provide any safety thresholds. And so they have dominated this due to cost and just ease of use. There's a whole market of technology called CPR augment devices that they go in between the bag and the mask for the patient, and they provide a safety pop-off valve, which eliminates the safety issue. And then on top of that, they create this flashing light so the first responder knows when to squeeze the bag, providing that additional cue. But at $200 per patient per use, it's an expensive thing to do that doesn't really improve the situation that much. There's other devices like oxygenation devices, but they don't provide anything for rescue. And then there's the high-end ventilation devices like the Zoll Z-Vent. They're capital equipment, over 10 pounds, carried in a Pelican case, and cost $20,000 to $25,000 per unit. So why can AccuBreath solve this now? Basically threefold. Technology has made it that we can create an ultra portable ventilator with the high-end sensors, battery power, and a turbine radial blower, all small enough to work in this ultra portable device. I've got one of our prototypes in my hand, very small. You can see it's actually even smaller than the bag valve mask, and it weighs only 1 pound more than the bag itself. Market shift. There's a shortage of first responders, and yet there's increasing calls out there, especially with cardiac arrest, which requires respiratory support. And then the market is shifting dynamic-wise. It's been happening over about the last decade to be focused on patient safety, patient-centered, and even the group now that recommends the two-handed use of the bag valve mask is actually just recommending mechanical ventilation over manual ventilation because it's so inconsistent. And so AccuBreath solves these challenges and is basically at the point, at the spear point of this market shift. We have this ultra portable device, very easy to use, can be used one-handed, can be used on the patient's face, off the patient's face. The sensors and the algorithms adapt to the patient and their breathing because it's constantly measuring what's in the lungs and what's going on. And then it's very simple for the first responder. You push a button and the device makes sure that you don't over increase the pressure past a certain safety threshold and that you don't hyperventilate the patient or provide too many breaths per minute. So it's done adequately. So the patient gets up to ventilation and stability as fast as possible and as easy as possible, making everyone's job easier. You can see what we're currently using. These are being built and tested and where we want to go with this raise to a final product, more durable, more rugged, and with a hot swappable battery, sort of like a power tool that'll make it really easy and friendly to use for EMTs and even military use. The market of just these manual bags is actually surprisingly large. 100 million of these are purchased and thrown away every year across the globe. It's about a $3.5 billion market, and it's growing at 6.6 CAGR annually. So surprisingly great opportunity here. The US is about 50% of the use, and a hypothetical SOM could show you what we could be doing in about 5 years if we reach those numbers. But AccuBreath is so much more than just resuscitation. It's a platform technology. So yes, we want to replace the bag valve mask completely and get rid of it. But with the push of a button, our device goes from rescue mode for resuscitation to BiPAP mode, which provides bi-level assistance breathing for transport. That's another device that actually would be used in an ambulance if they have it, they can afford it, or they would have to bag the patient the whole drive. Our device, shift of a button, shift of a mode, provides that assistance during the whole transportation of the patient to the hospital. If the patient is stable and doing well, and they might be discharged on site, the first responders will hook them up to an oxygenation device like a CPAP or maybe an oxygen tube. Our device can do that as well with the push of a button, goes to that mode. And it can be done with all one consumable, which I can state is less expensive than any of these combined. And two, our consumable, we actually just found a vendor that is going to be able to make it so our disposables biodegrade within a year into the ground. So great opportunity for us to decrease medical waste. Our business is based on a razor blade model. So you have the ventilation technology, yes, and we are inexpensive compared to other ventilators, but still we're a high-end device, around $4,000. But every patient needs a consumable mask, something clean and sanitary for them. And that's where our margins are the highest. And as our use cases grow, you can see the razor blade model generating very high revenue as our margins go up with each consumable sold. It's very likely each device will use somewhere between 100 to 125 consumables per year, according to population data. Briefly went over this. We can talk more about this later. We have built this company from the ground up. I've been with it from the very beginning. Dr. Fogarty invented this technology in an anesthesiology lab at the Bioinnovation Group at the University of Utah. Follows the Stanford Innovation System. It's very great in creating technologies. And we have great people with exits, medical device companies in operations and sold, and C-level executives all coming in to help us get this to market. AccuBreath has 2 fully granted US patents. We have a third that's under office action right now. We believe it'll be granted soon. And that all started with our very first investment from a group called IdeaShip. If any of you have heard of them, they're the brainchild of the GTT Group and the Panasonic IP Corp, 2 giants in intellectual property. They solely invest according to the potential of your intellectual property. We are raising $2 million over the course of next 2 years. We've closed 300,000 and we've opened up this convertible note at around 750K is what we want to close soon to get us to certain levels. And then we'll raise tranche 2 coming next year. You can see what we are trying to accomplish. We're already in the middle of the design for manufacturing and going through the ergonomics and this redesign of the handle, the battery, and those things for the first responders. The terms of the convertible note we feel like are very favorable to get in where we are. We'd love to discuss this with anybody that are interested. To date, we've done just over 1.7 million non-dilutive funding with the National Science Foundation. We have a completed due diligence report with Keiretsu, and it was Keiretsu and Park City Angels that disclosed that $300,000 for us. We're in due diligence with a few other, and here's some of the other groups that we've been working with. We are a medical device. So we are a class 2 510K process, we have very clear predicates. And with that in mind, what we need to do as a device to get on market is to show that we are equivalent to what's currently approved, our predicate. And so we can do that with a couple of different bench testing studies under certain protocols, and even a volunteer study of about 10. Is it appropriate? And we plan on doing both so we can have all the marketing claims needed to get through the FDA. Our technology, once again, is a platform technology. Emergency services is the lowest hanging fruit with the highest pain point and also the highest use case. But there's clinical applications within sedation. Every aviation, every plane across the globe is required to have one of these bags, and it's flight attendants that have to bag patients. So we have a great opportunity there. But the highest opportunity that would come in the future, and it would require significant work, would be getting to the point where AccuBreath or an assistive respiratory device was required to be next to every AED in the country. And at that point, you go from a $3 or $4 billion potential to a $30 billion potential, because there are so many buildings across this, millions of buildings, that would require a device like ours. So the great opportunity for something very large in the future. However, we know those are big dreams. We are dreaming, but we think AccuBreath could easily have an exit within about 3 years of sales, about 4 years from now. And that would be based around about 16,000 active units and 2 million disposables. Current pitch book data suggests a 5x multiple of EBITDA. So that's where we come with this 30 or 384 million exit, showing what those could do, what investors could do on a return on investment if they got in early. AccuBreath truly has a lot of potential to improve healthcare and to improve the situation for first responders. And let's be honest, they have a difficult job and they deserve better than what we're currently giving them. And we believe AccuBreath can supply that. So thank you. What questions do we have?
Great, Spencer. Let's go with the Jeremy. Jeremy, what questions did you have?
Yeah, it's super interesting. And great presentation. For me, the piece that's missing in the storyline, this is actually true for some of the other presenters, is, at least in my experience in selling into the space, is there's winners and losers, and trying to understand sort of the economics, the reimbursement, and sort of the motivation for change is going to be your biggest challenge. So I'm just sort of curious, how do you replace what seems to be a very low cost bag?
That's a great question. We have a specific strategy to do that, and that's by providing this razor blade model with actually the device being either leased for free or leased for low cost. We have the flexibility in our margins to get in the door with no cost barrier to entry. So we would sell our disposables around the same price they're already buying bag valve mask, since we want to replace that unit. And then as long as they contracted enough disposables over an annual period, we could then provide them a unit for free. Within 6 months, we break even, and within 1 year, we make a small margin. But then if that adoption continues into year 2 and year 3, we then start to make significant money with the consumables over time.
Got it. In terms of sort of, is this through some sort of CPT code where it's just bundled into a emergency, so is it eating into margin? Like how does and who's the buyer? So like, is it the emergency medical service? Is it the ambulance? Is it, yeah.
Another great question. So within EMS departments are very fragmented. So every fire department is typically run either by a city or by a regional group. This is one in Sandy. This is the buyer at the Sandy. He purchases about 75 BVMs per month for his fire department. There is no CPT code in emergency medicine for this. So first responders, it doesn't matter how many consumables they use to save a patient's life. They only get to bill one code, right? So if they used every device up here and it cost them $400 in disposables, they still only get a bill emergency services, and they get reimbursed some global amount like $900, for example. So if we can actually decrease their disposable costs, they have a return on investment for our technology. We hypothesize that we can save anywhere between $30 and $40 per patient for that reason. And so we're working on those unit economics. That's a little bit hard to nail down, but they might be able to start improving their overhead costs because we have one consumable that runs through multiple aspects of care instead of them having to do multiple consumables for each product. So great
So
questions. Thank you.
I'm sure you're thinking about this, but again, trying to think about how do you pull back into, let's say the hospital, you have it on this slide, like BiPAP or CPAP, or pulling into a higher value revenue stream, either by adding, again, different kinds of disposable or different kinds of units. I like your entry point, but my worry is when you're eating into someone's margins, people get really, as you said, they could spend, they could use 2 consumables or they use 400. At the end of the day, they're only going to get 1 fee. And the more consumables they spend, the more money they lose. And so, if your system has a lot more value, then my guess you're going to get attributed for, other than maybe just ease of use. Like you may end up finding that the people will spend that money just because it frees up their hands, or they could, they can focus on other things. This is a pain point, but again, pull through for the bigger dollars and higher accelerated growth might be some of these downstream use cases.
No, I appreciate that feedback. I think that's valid. We are still working on those. Truly, we are. So,
yep. Cool story. Good luck. Unfortunately, it's not for us, but good luck.
Thank you.
Great. Tabriz, did you have a question?
No, this was helpful and good to learn. Thanks.
Great. Thanks. But my question, Spencer, is tell me more about the exit strategy here. What do you think is the likely path, and when would that likely happen?
So great question. In our space mostly, so there have been very few exits in ventilation technology recently because the big players have dominated the space. So the first US approved ventilation device was actually just approved recently. And it's been 20 years since that happened in the US. And it's very likely they'll get a large exit soon, but they are ICU ventilation technology once again. Nothing has really been in this space to automate something that's so, it's known to have issues, but it's so simple and cheap, like we've brought up, that no one has been able to compete at that price point. So we are unique in that space. But with us being a platform technology, we do believe that we can start spreading our wings, so to speak, once we're on the market, because it'll be very easy to use our technology once it's in the hands. 16,000 active units for us is actually a very small number. It's 2% of the market. And that's a $2 million disposables with or 2 million disposables with just EMS personnel. So we don't see a lot of challenges in this space. We've been in talk with distribution already. Here's a company that covers about 30% of the United States. They've already given us a letter of support that they would love to try our product out once it's FDA approved. And that is our real hurdle. For us, we need to design, freeze, and get through the FDA so we can prove ourselves on the market. Our FDA process is it's not a if we get through, it's a when, just how many hurdles we have to jump through. We need funding to do that, obviously. But we truly believe that we can get this in the hands of people and they'll start using it. We've collected over 200 interviews with first responders, and we've had no negative feedback other than cost. How is it going to function? How is it going to use? But the great feedback from everybody has been, oh, I would love that. That's so much better than the bag. It provides tidal volume, respiratory rate. It provides feedback and data that they don't get with the bags now. So we're very confident.
That's great. Well, we're at the end of our time. I want to thank you, Spencer, for a great presentation. I want to thank all of our presenters. They did very well today, and want to thank our investors for asking great questions. As far as follow-ups go, I have on the list to introduce Jeremy Son with Angiex. Was there anybody else, Jeremy?
All great companies, but Angiex is the only one that's a fit for the fund. So thank you.
Great. Tabriz, did you have one you wanted to follow up?
No.
Okay. I have the follow-ups for Akash, Jasper, and Pete, who had to drop off, so I'll make those introductions afterwards. I want to thank you guys for joining us today, and we'll see you guys next time. Looking forward to next steps here. If you have any questions for me, just drop me an email, and I'll be glad to catch up with you. With that, we'll go and wrap up for today and let you get back to it, and hope to see you next time. Have a good one.
Thanks, everyone. Good luck.
Thanks. Bye.